if your deal's not big enough, or if those fees, if the fees don't make sense for how we're going to be investing the funds based upon your risk tolerance, then this may not make sense. But who this is not for, right? Just as important as why to use the deferred sales trust, it's just as important to know who this is not for, because it's not for everybody. And a 1031 exchange may be a suitable reason to a way to defer capital gains tax for you, for your circumstances. Perhaps you also have a deal that doesn't have $1 million net proceeds or $1 million gain. Okay, those are the two things that are very crucial to understand. That if your asset is less than $1 million in gain, as well as less than $1 million in net proceeds, we found that the deferred sales trust, it just doesn't make sense because of the fees, which we'll talk about here just in a second. Now, on a primary home, by the way, we do want to make sure that it's even more than that, because you have what's called the 121 exclusion, which basically means if you're married and you've lived there for 2 of the last 5 years in a primary home, you have a $500,000 basically increase on your basis, or single, it's $250,000. So primary homes do need to be a little bit bigger, but otherwise, the $1 million net proceeds, $1 million gain is a great kind of immediate, litmus test, if you will. Now, if it's a little bit less and you have 2 assets that you're selling, right? Those assets, by the way, can be primary home, can be investment real estate, can be a business, can also be cryptocurrency or stock. It could be collectibles. If you have 2 assets that have that $500,000 gain and a $500,000 net proceeds that you can combine to make that $1 million, that can also fit as well. And so I don't want to necessarily count everything out, but just realize that if it starts to be, well, I have 10 assets and collectively, they have a $1.6 million gain, and it's about $900,000 net proceeds, the cost and the association with that could just not make a lot of sense for the ROI. That's what we found. Okay. So number 2, you have a good 1031 exchange to invest into, a good investment or a good 1031 property to move into, and you're selling investment real estate. Hey, we love 1031 exchanges. I'm a commercial real estate broker. That's where I started out my career. That's what I still help people do, is buy and sell investment real estate, mostly multifamily is my expertise. And we have teams across the country to help with luxury real estate and multifamily. And so if that's something that you're looking at and you have a great 1031, fantastic. We love that. We can be a backup plan for a failed 1031. So you still work with us, and we can set that up as well, just in case it does fail, and we can still use the deferred sales trust. But if you have a good 1031, go ahead and use it. Number 3, you have carry forward loss. There's to offset your capital gains tax. We have seen this in the past where I'm working with a potential client, and I just ask a couple questions like, hey, do you have potentially any carry forward loss from a couple of years back that you could apply, talk with your CPA, and offset the gain that you're going to have in this given year? And if you do, perhaps you don't even need the deferred sales trust or a 1031 exchange, or any other thing, because it's just going to offset it, because you already have those losses that have been built up. We call that tax flow, or tax loss that's been built up, and it can offset the gain. And so make sure you check with your CPA and your circumstance on that. Number 4, but you don't have a 40% estate tax challenge. So if you're not above 24 million now, although married, 12 to 14 million in about a year and a half, you're looking at a 40% death tax. So you're not looking at it. I'm sorry, it's a better way to say it. You're not looking at that. If you're above those exclusions amounts, it's important to understand that a stepped up basis doesn't solve for that estate tax. And so if you're not above those amounts and you don't have a great way to eliminate the estate tax, the deferred sales trust is for you. If you're way below those amounts, then you don't really have an estate tax challenge. And so it's the deferred sales trust it may not be a great fit for you. Okay. The next one would be, this is not for you if you want to or need to spend all of the funds on personal goods all right now. It's important to understand that the deferred sales trust will pay you per a promissory note over time, and you'll slowly pay tax, and you can spend that and do whatever you want with that. But if you need all of the multiple millions of dollars spent right now on your primary home, or to be spent on just goods and services that you're just consuming, this is not for you, because it's going to be taxable. But most of our clients like to live off the interest that the principal amount is procuring in the investments. And per the promissory note, You live off of that, and you're able to. It's a repayment of what went into the trust. You're able to pay tax slowly, and that's your income stream. And so that's how that works. But if you need or want all of it for a down payment, I have some clients like, hey, I always had a goal of selling my big primary home, and then buying something all cash. Well, it may not be the best fit, given that you're going to have to pay, like in California, for example, 33 probably minimum up to about potentially 37% on properties, and more depreciation recapture can be more. So if you need or want to spend it all on personal stuff, this is not a good fit. But perhaps you can switch and take a portion of the trust payment to pay you up front, and you can pay tax on that, and you can use that. The next thing has to do with fees, right? Our fees are not inexpensive. In fact, we do try to keep them institutional, but it does take a team of professionals. We like to build kind of like a family office style environment for all of our clients. We're bringing in the best professionals. My role, by the way, would be a deferred sales trust trustee. So sort of like an offensive coordinator that works with this tax attorney who sets this up, works with your CPA, works with a financial advisor for the trust, works with commercial real estate operators, works with you as the entrepreneur to do another deal. I mean, all these things are taking to place that we're going to be here for you to guide you and help you every step of the way. And so that does cost money. And in fact, it's about 1.5% to 2% on a recurring basis, no matter how and where the funds are invested. And that includes the financial advisor as a part of the team, and that includes the meetings with us, the statements, the reviews, the strategy, all of what you would expect if you're working with financial advisors or commercial real estate brokers for your transactions, whether it be real estate, whether it be in the stock market, whether it just be planning. You want to make sure you have a team, and so that's a part of what that includes. Now, there's also an upfront fee to the tax returns who created this, and that's 1.5 million on 1.5% on the first million, and then 1.25% on anything above. And so, if your deal's not big enough, or if those fees, if the fees don't make sense for how we're going to be investing the funds based upon your risk tolerance, then this may not make sense. But we have found that the general promissory note, somewhere between 6 and 9%, depending on your risk tolerance, net of recurring fees, as long as you have that $1 million gain, $1 million net proceeds, the deferred sales trust is a great fit. Okay.